Hi everyone. So welcome to the new video on SI conversations. And today we have somebody from banking industry who have more than 2 decades of experience. In fact, more than 25 years of experience in banking, working across different banking sectors in India, outside India, with some of the most reputed names like HDFC Bank, Citibank. So we have Arvind Datta, sir. Welcome, sir. Welcome to the Scientific Investing channel. And we will talk a lot about banking and where the industry is going. But before that, we'll talk a little bit about Arvind Datta, sir, his background and his journey. So, sir, welcome to the channel. And if you can just introduce yourself, about your journey, how you got into banking. And I think you have a background from defense also. I don't know if many people know. If you can, share some of those personal, backgrounds also.
So thank you, Saurav, for inviting me for this session. First of all, it's really a pleasure to all with you. With your kind of expertise in the stock market, it's always a lot of learning because it's been almost 2 years now. I've been kind of Twitter and we've been part of some of the common groups as well. I always wanted to become an army officer. God had other plans. So I come from a background of a family of army officers. My grandfather was in the army. My father was in, and there were my father, a couple of brothers who were into the army. So when I was in college, my only aim was to qualify for the military academy and pass out as an officer. And I did almost like 17 months of training out of 18, but then I had an injury. I was invalidated out of medical grounds, and then I kind of pursued opportunities outside. So I got an opportunity with a financial company, and that was the beginning of my journey into BFI space. And as they say, rest is history. So from one organization to there were a lot of learnings for me, and as I grew in my career and my job profile, a lot of things that I thought really you could probably learn and then move ahead, and that's been my key motto, that learn as much as you can from a job or from others that you interact with, and rest everything will fall in place. So that's about myself, I think.
So, sir, then how the foray into banking happened, and how did you start, and how did you again went? I think you spent more than 10 years outside India. So, tell us a little bit about that.
So I had a friend who basically broking, and then he used to also sell company fixed deposits. At some point in time in the 90s, popular instruments for people to kind of invest into company FDs, where there were NBFCs, there were corporates, etc., who used to kind of borrow a lot from the public through company FDs. So he used to be interacting with people from various NBFCs like ITC Classic Finance, Lloyd's Finance, and Alpic, and all those. So they used to come to his office to kind of solicit business. So I went to meet a couple of them, and while talking to them, I understood that financial services probably has a good ability of growth in India going forward. So that is how I kind of then veered towards financial services, went to Delhi a job, and that's how it all started basically.
Okay. And sir, I know you have quit your job, but you are very much active in the market, and I think you're doing something on the personal side also. So given you have tremendous experience in banking, what are like some of the big learning you had during your job tenure, which is useful in the market and you are using right now?
So the biggest learning I had in my was in sometime in between 2000 and 2002 to 2003, basically, if you ask me. I used to be a manager with HDFC Bank, approving car loans and personal loans. So we were very tight on the credit side, and we used to have a lot of rejection, like 30-40% of the cases used to get rejected. But we had a competitor who was the number one. Everything used to get approved there. So the RMs, the sales RM we used to have, they were always complaining to the credit teams is that our approval rates are very bad or pathetic, and dealers don't like working with us, the car dealers, the auto dealers, because the file into the other bank, it gets approved, 100% of the cases get approved, whereas at your bank, hardly 7 get approved. So then what happened, then we saw that the other bank was just chasing market, right? And in 2007, 2008, when the global financial crisis struck, the chicken skeleton started tumbling out, and they had to kind of stop business. And that was a time that we saw HDFC Bank press the retail side, and then kind of every dealer had no choice but to come to HDFC Bank for business, right? So that is learning that you need to be kind of very controlled in your lending. The same thing repeated with Citi in 2007-8. Like I left Citi in 2007 just because of the fact that I realized that he was doing something what I had seen in 2002, 3, and 4 being done by the other bank. So that time they were chasing unbusiness like anything. And when the global crisis hit, Citi also took a big hit, and they had to kind of wind down the business. They had to then kind of be in the US government. India became a non-strategic part for them, and they chalked out certain amount of some verticals which were kind of Citicorp, because they were not fitting into the city's global strategy. So this is something that it has stuck to me. When you are just chasing growth, when you're just chasing blindly chasing market share, you are likely to kind of suffer a lot of this pain going forward, right? So this also has to be kept in mind when you look at investing into banks.
Okay, and is it valid only for banking, or like you take this lesson for any industry where they're chasing growth and market share for
For other industries, they are selling a product, right? So they have a tangible product that whether you're selling a soap, whether you're selling a FMCG product, or let's say a consumer durable, it's up to the customer that whether he likes the product, whether he would buy, or he would probably be recommending your product to others based on his experience. If like you chase growth on by undercutting your margins, will go for a toss, right? But at the same time, in banking, you don't have a tangible product. You just give out money, right? The most important factor for a bank is that money has to come back, right? So FMCG, once you sold or once you consumed, you done it to the manufacturer. Similarly, for consumer durables, like maybe you can have a warranty for the product if it's not kind of working fine. You can't just say that the manufacturer will take it back from you, right? So that is the inherent difference between a product company and a company like banking.
And I cannot wait to ask one question, because you said you worked in HDFC Bank in 2002-3. And we see a lot of these messages. If you had invested in HDFC Bank 20 years back, you would have made this much. So did you know HDFC Bank will become the next HDFC Bank 20 years back while working? Or
so good. So you learn only by experience, right? So just to give you the background, when there was a concept of ESOPs being given out, right? So first tranche of ESOPs, I had some 40,000 shares to be vested. So every 3 years there used to be a tranche that used to be given to employees based on their level, based on their performance. But at that point in time, in 2002, 2003, we didn't know the concept of ESOPs, what value it can create. So my ESOP price at that point for splits, etc., was around 22 rupees. And that time the share price was 26 when I quit the bank. So I said, for much of money, probably I don't want to kind of vest these options. So I let go of that. So now you learn that people who stayed back in HDFC Bank, who were my colleagues, who've been there for 20 years, they've made a lot of money. But then I realized that, yes, if you have to kind of be an investor, you've got to have HDFC Bank in your portfolio. So I bought it later.
Okay. Okay. And sir, you have worked for almost 25 years. So you have seen, almost 2.5 decades. And we know most of the industries are cyclic, and, banking is no different. So my question is how, and, I think catching cycles in any industry, that is, one of the biggest skills one can have. So how do you understand the banking cycle? And if you can give some examples which can help us to understand if, we are at the bottom of a banking cycle or if we are top of a banking cycle, both from industry perspective as well as from, an investor perspective, because, the industry cycle and the investor cycle, they are not, perfectly matching, because the market is always, a few months ahead. So if you can throw some light.
Yeah, so banking typically is cyclical. You will have a good period, 2-3 years, and then probably you will have a period where the growth slows down, the NPAs rise. So sometimes it is corporate banking, sometimes that goes into a trough, or then you could have probably an MFI crisis that comes up every few years, or you could even have a crisis that comes up, right? So if you look at the last 15 years, 2008-9 was more of a retail crisis. Retail banks took a hit because of the job losses, because of the companies that had to take hit reasons, right? Then you had the next cycle, which was a corporate cycle, right? 2014 to 2016-17, if you look at it, there was so much of lending that was happening on the corporate side, right? Then 2016, when we had demonetization, after that, the banks took a hit, right? There was liquidity crunch. The companies who were highly leveraged were not able to kind of sustain revenues or the cash flows to pay back those loans. And you had the commodity cycle peaking out. So everything came together. So then the saw banks like SBI, ICICI, Axis, and other PSU banks that took a massive hit on their the corporate loan portfolios, and they had to write off a lot of these loans as well. Then you come to the COVID-19 crisis, retail crisis, and in between you had a MFI crisis. Like 2011, there was a MFI crisis. If you are aware or heard of the SKS Microfinance, which is now called Bharat Financial, right? It was one of the largest companies in India, or probably the largest company in Indian time. And it was a leader in Andhra Pradesh and southern states, right? And then you have Spandana Spurti. So Anand changed laws on the microfinance side and they tightened it. Overnight, the industry was almost killed, right? These are cycles that will always play out in banking in every 3-4 years. So how do you catch it? Probably you have to be with the bank fairly conservative in their approach, and who kind of have weathered the storm in these past crises or cycles. So they kind of are aware that what the mistakes they made earlier, they should not be committing the same mistakes. So if you were to open my presentation I had shared with you, there is the credit cycle, or probably the loan growth cycle that you will see. So first 2 slides I've just picked up from a presentation from DSP Mutual Fund. Look at the credit growth. Every 2-3 years it peaks and then it kind of drops, right? So currently we were at, last year in September, October, we were at 6% credit growth, which was probably the lowest if you look at 2007, right? Or it was probably 1987, we saw 6%, right? After that, for the second time in last 35 years, we've seen 6% in 2021. So now if you look at it, the last 9 months, the credit growth has been slowly and steadily rising. So if you look at the yellow line, is the rolling 10-year rolling average. It's moved up the 10-year rolling average, which is at 10%, and we are currently at 13%. So it tells you that it is a beginning of a new credit growth cycle. The next 2-3 years will see banks kind of doing very well. The capex will return, the working capital cycle will return. The retail as it is has been very strong in the last 1 year. Retail lending business, MFI hopefully would have cleaned up, the sector would have cleaned up of the mess, and we will see this cycle kind of moving ahead strongly in the coming quarters.
Sure. So a lot of insights. So one, I think one bank itself is a group of multiple subsegments like MFI, retail, commercial. So one, we need to understand from that level. The second point I am taking home is every 3-4 years this cycle will happen. So we have to understand the overall credit cycle like you showed for banking. But also I think if we look for respectively, these kind of, the retail segment, commercial segment, we will be able to time it in a better manner. Okay.
Yeah.
Okay. And so the next question is, so again, banking and any lending business, not only banking, but when it comes to, NBFC, MFI, this is a very complicated business. And many times we feel कि annual report वो सब पढ़ के भी कुछ पता नहीं चलता, because this year the companies will show such a good, nice growth, no NPA. And then suddenly after 2 years, you will see growth has decreased and a lot of NPAs increased, and annual report पढ़ के तो सब ठीक ही लगा था. So it looks like an industry where it's little difficult to catch the good versus bad, and the standard way of analyzing companies doesn't work. So what are some of your suggestions how we can assess the quality of the books, quality of the bank's lending business? One point I do remember, in the previous question you said the bank should weather the past cycle. They should have some kind of history. So of course I'm taking that point. That is one way. But apart from that, what are the other ways to assess good versus bad lending institutions?
Very difficult to actually, honestly, that's a very good question that you've put across, but it's very different of analyze other than what is available, the data that is available in public domain, right? Unless until you talk to them, some bit of information probably can come in. You've seen that banks which were kind of doing very well and suddenly they're showing huge NPAs, right? No one expected those kind of numbers to be shown. So there is a lot of camera happens, no doubt about it. There is some evergreening that happens on the loan side that you kind of you rebook, restructure them, etc. And then which kind of masks the pain to a certain extent for some, right? Even RBI for that matter cannot go loan by loan, right? So RBI, when they do an audit, the inspectors that annual audit of the bank, they do a random sampling of loan cases. They will look at every product and they will probably select some sample cases which have been booked in that product, and then they look at those loans, documentation, the repayments, whether everything was in order. But it's in lakhs of loans that are booked like every year. So not every loan the auditors or even the central bank auditors can go. And so that is why you see that if the bank wants, they can kind of mask a lot of this data, which probably will in the public domain. But after a certain point, when you don't have any other alternative left, it starts to kind of blow up, right? You have seen that the failures in non-banking companies as well, right? Frauds that have happened, or probably the window dressing of finance. If you look at the past history of frauds in the last 4-5 years, the companies that have kind of gone bust. So similar thing exists in the bank. The difference is that the regulator will not let a bank fail, or probably the depositor money go down the drain. They will have a kind of a mechanism to bail out the bank and probably merge with a stronger bank. So if you look at the history, we had Global Trust Bank was merged with when it failed one sudden Sunday evening, suddenly RBI realized that it had gone It was about to kind of go by. Then you had other examples recently as Yes Bank that was bailed out, Lakshmi Vilas Bank was bailed out, and there were so many cooperative banks that have gone bust also. If you look at PMC is the biggest example in the last 3 years. So you will have the that keep coming up. You also had a situation in Centurion Bank. I don't know how many of people will remember there was a bank called Centurion Bank. RBI, it was on the verge of failure. So RBI appointed an administrator. Then they kind of Sabre Capital was brought in to kind of rescue the bank, turn it around. So Sabre Capital is a PE firm led by Rana Talwar. He hired some of the best guys to bank, and then when the bank started doing well, he also acquired Lord Krishna Bank and merged with Centurion, and then later on he acquired the Bank of Punjab also, and then later on Centurion Bank of Punjab merged with the HDFC Bank, right? So you will have these instances very difficult to kind of check what's good, what's bad. But the key is that stick with some of the reputed banks which have a reputation which in the last 15, 20, 30 years, and probably the management is clean and you can depend on them. So I would recommend probably rather than with some of the unknown names, is better to kind of stick to the tried and tested ones. Though your returns probably could be, but it's worth it.
No, totally makes sense. And I think tried and tested with history and, the big well-known names. And in fact, my personal experience also, I think the places where I got saved, I realized it was not because of my skill to analyze, but as you rightly said, I had some ground level information of something which is going wrong, and that is what saved me. And where I missed that, all that reading didn't help. And in fact, one of my worst investment has been, one of the banks. So I totally agree with you. So, sir, now I think already you said that when you were discussing the cycle, you told that, the 6% kind of credit growth rate, it has happened, I think, second or third time in last 25 years. So looks like, we are well poised for again a good credit growth rate if we try to understand. But isn't this time we have some new recipes to the story? So we have fintech, we have digital, we have co-lending, we have neobank. So there are a lot of new age developments which has happened. So one, how do you see these new developments playing into banking era, and how do you see some of these listed companies? Are the traditional banks are getting disrupted, or are they adapting and becoming more techno savvy, but still they are expected to do well? So from a growth perspective and from all this disruption perspective, how do you see some of these new things emerging in banking era?
So no doubt technology is rapidly changing today in the banking sector, right? Like any other sector, technology is also banking, and it is shaping the way people bank today, right? So fintechs will exist. They are going to grow, but they're not going to eat the banks, because banks today are much more prepared probably they were 10 years ago, right? So you have seen that fintech will coexist. There could be even partnerships with fintech that the banks will have, or even they will kind of compete with some of the fintechs. They will even kind of these fintechs, right, tomorrow. So we will see that there will be a hybrid model where there will be partnerships or co-lending and call, or probably sourcing certain products for the bank, where banks are much stronger than fintech, right? If you look at fintech today, fintech is more active on the unsecured lending side, whether it is SME, whether it is personal loan to individual customers, but they have challenges like their cost of funds are high. They probably do not have the collection infrastructure what banks have today. So there could be some amount of competition from fintechs. There will be partnerships as well. I feel today banks are also kind of investing heavily on the digital side. So it's not something that banks are unprepared for. What if you are 10, 15 years ago, not many people could realize that how technology is going to shape their industry. But today, a lot of awareness. Banks are transforming themselves. Banks are putting in a lot of money on the technology side by adding platforms, by doing away with these processes that were manual, that were paper heavy. So it's all moving to digital. And my guess is that there would be some competition, some products will sell more with fintechs, probably banks will sell more in some of the other areas, the partnerships on that side. And secondly, also remember that RBI will kind of also regulations where there are no undue advantages to a fintech, right? So you saw the credit card thing overnight kind of stops for fintechs who were active in the credit card space or through the prepaid card model, right? The BNPL and stuff. And then you have to also see that if liquidity tightens, how many fintechs have the wherewithal to borrow money and from sources and at what rates? So next 1 year is going to be interesting. How many fintechs survive? How many close down? Or how many probably put them up to be merged with some of the banks? We'll have to wait and watch on that sector.
Sure. And sir, what about co-lending and neo-banking? In fact, I see some of the NBFCs, they are shifting their model to co-lending model. There are some companies like, I think, Agro Capital, they are, building a business model around co-lending. So what is your view on co-lending and neo-banking?
Yes, so co-lending is a very good opportunity for some of these NBFCs, right? Or the fintechs basically, because you don't have to then borrow a huge amount of money for your lending business, because then it's a 80-20 partnership that you have with the bank. 20% you put in and 80% the bank put in, and you are given a fee for sourcing, and on 20% you earn your returns basically. So good win-win partnership for banks, because where banks can't reach, probably these fintechs or these new age NBFCs can reach and source for business for the bank. Secondly, it also keeps the cost down for the borrower, because when you are having a co-lending partnership, let's say within PSU banks, obviously the cost of funds are lower. So the customer is benefited, the intermediary or the co-lending part of fintech or the NBFC gets benefited, and obviously the bank gets benefited by increasing their business without kind of putting in brick and mortars or other sourcing channels, which probably cost a little more.
And sir, is there any risk you see with the co-lending model? Like the standard banking risks are there, but any specific risk is there?
So as of now, the risk is again that if a bank will go aggressive, because this co-lending is happening today on the micro and small sizes, right? So the risk again is that if you go aggressive in lending, and some of these SMU, some pain probably for whatever reason in the next couple of years, it will impact lending portfolios, right? The next probably crisis would be on the SME side, because if every bank is focusing on SME with co-lending partners, there could probably be a bubble 2-3 years which gets built. So we don't know. So people have to be like cognizant of the fact that this could be carry a certain amount of risk if the banks or the banking partners go aggressive on certain SME segments.
Okay, got it.
And if you don't price for risk, because SME carry a higher risk basically than a non-corporate or a large corporate. So you have to price for risk so that whatever losses occur, you should be able to absorb them, and it kind of should not take away your profit.
Got it. And sir, I think you already said that, we should stick to tried and tested banks, with a good history and all. But even if you have to, go beyond and, you have to explore a little bit and maybe get into companies, beyond the Kotaks and HDFC banks, what are the, key 4-5 metric one should look into banking? And, in banking, we talk more about book value, more about ROA, ROE. So if you can throw some light, on some of these metric and why these metric.
So one is obviously you have to look at on the liability side, how is the CASA growth? Because CASA is a good source of low cost deposits for the bank, right? So if my cost of borrowing is lower, obviously I can kind of lend to customers which are prime, right? Where I can kind of price my loans to the level where the largest banks are today lending to the prime customers or to customers, corporates with a AAA or blue MNCs or blue chips that we call on the corporate side, and on the individual sides, individuals with scores like 750 plus or 800 plus. So that is one advantage that the bank should have on the deposit side. Secondly, if you have more granular fixed deposit, helps you to kind of have that deposit franchise, help you in kind of building your lending business. So your lumpy banks have, which come from corporate, which is at a higher rate of interest. If they start to go away, then you lose that advantage as well of the low cost of borrowing. Coming on to the lending side, how well is the lending book structured in terms of, is it equally structured across corporate, retail, SME, agri for that matter, or what is the proportion of lending to each of these sectors? Again, in corporate, how much is AAA or probably higher than BB rating that the bank has booked the business on? These are certain things that one has to look at it, and sectors to which the bank has lent to, right? Especially the corporate. So if you look at it, there could be steel, there could be infra, textiles, everything. So some of these are cyclical. So it depends on commodity prices. When commodity prices are high, these companies make huge profits, and when commodity low, the margins get squeezed, and then they kind of get into trouble if they have huge debt on their books. On the retail side, again, though secured lending is very good, but the margins are very thin. So on a home loan, a bank earns a NIM of around 2.5%, right? Whereas on an unsecured loan, the NIMs are high. So you can't go aggressive on the unsecured book also to that extent. You have that fine balance between unsecured, secured, and on the SME side as well, which kind of tells you that how much of a risk is willing to take. NIMs again is a function of your composition of the loan book. If you are a corporate heavy bank, obviously the NIMs are lower. If you are a retail heavy bank, your NIMs are going to be higher than normal. But then you have to maintain that balance somewhere in that. That's how I look at it. ROE is a good measure. Then you also have to look at cost to income ratio, how well their costs. If are they using technology, and are they able to kind of reduce cost per acquisition of a new, or kind of they're still opening branches, and how much of a cost that is adding up on a sequential basis, or these are certain things that one at it.
Great. And sir, what are some of the companies you are talking? And let me tell to the audience, even if we are discussing few stock names, we are not recommending anything. We are talking more in terms of what we are studying, and the max you can do is you can study, but nothing is a recommendation. So sir, what are some of the stocks you are studying, given you said?
So if you, I just want to start with a slide. If you were to go on that presentation, you go to the next slide. This is something that it talks about, that when the bank's price to book is less than 2, you tend to invest, and then the cycle kind of makes you a lot of money, right? So currently we are at 2 times book value overall on the banking sector, right? It's been as high as 3, 4 if you look at that. And the gray line is price to book ratio trailing bank nifty index. The blue line is the bank nifty, and the gray line is your price to book ratio on a trailing basis. So if you were to move on the next slide, I have given you
And
a comparison between...
Sir, I will just add here. So one, you are expecting a good credit growth, and then we are also at the mean of the valuation cycle. So if there is some kind of valuation re-rating, which is further added by the growth. So basically what we are expecting is the return which we could get will be much more little higher than the EPS growth, because some kind of valuation re-rating is also possible, right?
Yeah, so there would be obviously re-rating once the profits start to grow and NPAs kind of start to taper down. Then obviously this cycle probably will reverse, or the line will start reversing in the next couple of months, hopefully. When it will, we don't know, but we are expecting that probably in the next 3 months, you may see the banking sector bottom out.
Sure.
Right? So hopefully then the cycle return and the credit growth would have returned. So this is a comparison between Nifty 50 and Bank Nifty for the last 15 years, right? So you look at it that if the economy has to grow, the banking sector will grow much, much faster, or much, much higher than the economic growth that the country sees. So if you look at it from 2007-8, Bank Nifty has outperformed Nifty, right? So this is one indicator that you can't be away from banking stocks if you have to create wealth through stocks, right? And this is a sum total of all the banks on the Bank Nifty, the banks that you have on the Bank Nifty. Moving on to the next slide, I have given a comparison between the top 4. So one obviously is that if you look at the last 15-year trend, the big banks are becoming bigger. They're taking market share from smaller banks. So this chart is about your Bank Nifty performance versus the top 4 private banks. I've just considered the top 4 private banks, which are HDFC, Kotak, Axis, and ICICI, right? So if you look at it, the outperformers in the last 15 years have been Kotak and HDFC, which are the two, the blue and the red one. And Axis and ICICI have barely kind of managed to mirror the returns of Nifty, or even like if you look at it, ICICI is still lower than Bank Nifty trend, the line that you see in the Bank Nifty. So this chart tells you that obviously the tried and tested, the HDFCs and the Kotaks have really created wealth for shareholders. But look at the last 2 years, Axis and Kotak have started to move up. So you never know that probably the leadership might be moving to these two because they've been laggards now for the last so many years, right? So then if you go to the next slide, is a comparison between top 4 PSU banks versus Bank Nifty. All are laggards. None of them have actually kind of come closer to Bank Nifty in the last 15 years in terms of return, except SBI, which is your line, which is the highest in terms of returns for a public sector bank. So one is obviously the market share, the business volumes are moving from public sector to private sector banks. Private sector is eating into the market share of public sector banks. So you also have to look into the fact that probably other than SBI, none of them are really kind of able to compete with the private sector banks, especially the top 4, right? And bigger players are taking away market share from smaller ones, right? The mid caps and the small cap banks. So next slide talks about your mid-sized banks, or probably the smaller banks, where if you look at it, some of these banks have even moved in the last 15 years. You have likes of Karnataka Bank, which is a flat line at the bottom. Then you have Federal, have City Union, which have been relatively better performer among all banks, because it has a good kind of, I would say, a reputation and DNA. It's done well over the years. So currently it's going through a crisis on the SME side. So hopefully they'll bounce back, right? CUB has been a performer. IndusInd, look at how badly it dropped. It was an outlier, and then it dropped, and probably now kind of somewhere in between CUB and the others, basically. So one is obviously you to see technology is kind of helping the large banks reach out to the masses faster than probably the mid-size or the smaller size banks or the PSU banks, right? People on their phones are able to do banking, open current account, savings account, order for loans or apply for credit card, etc. Today, the public sector banks are not as aggressive as probably what the large private sector banks are on the digital side, right? So you will have this thing playing out, in my view, in the next 5 years. The large is going to become large, right? So this is something I probably feel that if you have to play the banking sector, play with the large banks, the private sector banks, rather than playing the bank nifty, you could have your own ETF for 4 banks, the private sector 4 banks, or probably 5 banks. Take CUB as one of them, Axis, Kotak, ICICI, and HDFC as 5 banks, and make your own ETF and invest every month into it.
Got it. Yeah. And sir, you have something on the NBFC also.
Yeah, so on the NBFC side, the outlier obviously is Bajaj Finance. You know how much wealth they've created over the last 15 years. Others like Muthoot or Chola probably have been relatively better performers than, let's say, a Piramal Enterprises against the bank nifty, right? So Bajaj obviously at some point in time will plateau out, or probably the loan growth will start to slow. We saw in HDFC Bank that it used to be a 30% growth bank, then it used to be a 25% growth bank year on year, then it became 20, and now it's in 18% range, right? So obviously size will catch up with some of these NBFCs as well tomorrow, and the loan growth will start to taper off. And then will the same valuations continue? We don't know as of now. But as of now, Bajaj Finance continues to be the leader in the NBFC space. On the gold loan side, Muthoot is the leader, and Chola is doing very well, kind of expanding their reach, kind of getting into commercial vehicles or other products, auto lending and stuff like that.
Okay. I think great insights. And sir, this reminds on Twitter, there are a few questions, and one question is very pertinent to this slide. There were 2 questions actually. There was one question whether the advantage which NBFC had earlier, is that advantage shrinking? And the next question was, because you are showing Muthoot also, I think there was one question around, because gold is looks like a very secured kind of lending. The NIMs are good, and the NPAs are low, but still it doesn't get very good valuation given what is happening with Manappuram, and so any views on overall NBFC versus banks, and why gold gold kind of business doesn't get a desired valuation?
Well, RBI is kind of bringing in regulations for NBFCs which look to be at par with banks, right? They've brought in prudential norms. They've brought in the NPA recognition norms to 90 DPD. Earlier, it used to be 180 DPD for NBFCs at some point in time. So RBI is kind of plugging the gaps that NBFCs relatively enjoyed the arbitrage basically against the banks, right? So that advantage is slowly and steadily slipping away. We have seen that HDFC limits their reverse merger into HDFC Bank, saying that now the regulations are really almost at par with what probably banks are supposed to run in that sense. So that is one part of it. The second part is obviously NBFCs have a higher cost of funds, right? We all know that they borrow from banking channel and other channels, and their cost of fund is relatively higher than banks. So obviously they have to look for customers to they can lend at a higher rate to maintain their name or to maintain their margins basically. So that is one point of time. But NBFCs also play a crucial role in the economy to bring in customers who are not credit worthy to extent, or who do not have proper documentation available for them to reach out to banks to apply for a loan, right? Because the bank is stringent on documentation. right? They do not have the time to kind of look at pseudo income of a business and then kind of arrive that what is his income that he probably earns from that business that he runs, and then arrive at what could be the relative installment that you could give based on the debt ratio that you probably arrive at. So NBFCs actually plug in that gap where banks are not able to kind of go ahead. So what happens, this borrower comes into the NBFC, he builds a track record over 9, 12, 18 months. And then he becomes a prime borrower for the bank to take over, right? He builds up a score of 700, 750 plus, or even higher. And then he demonstrates by his repayment capacity, by his intent and ability, that he has the capacity to serve the loan that he has taken. Either it was a secured loan of mortgage of his house, or let's say a loan against property, or for that matter, any other asset, etc. So once he's demonstrated capability, banks are happy to kind of give him a loan at a lower rate of interest. So NBFC, we have seen in the last 2 years, NBFCs have been home loan portfolios to banks, right? There was hardly any credit growth in the system. The best business was home loans. So every bank was lending at 6.7, 6.6%, and they were just doing buyouts from NBFCs. Now with credit growth coming back, probably we will have enough food on the table where banks and NBFCs will be able to kind of book business and have that kind of rotation or churn that comes about, which will help them grow their interest income fee in coming months.
Got it.
And answering your gold loan query on the gold business. So businesses that were doing well in the crisis in the last 2 years. One was the home loan, the other was the gold loan business, right? It's a business. SBI will do it at 8%, CSB will do it at 12%, Federal probably will do it 11%, Muthoot will probably most of their business at 18 to 21%, right? Or Manappuram for that matter, probably it could be even higher at, let's say, 20 to 22%. So banks were kind of not able to grow their loan book. They focused on the safest business available, which was gold loans. So they started booking, and to that extent, gold is also like a cyclical. Gold loan is a cyclical business today. It all depends on the gold prices, right? If gold prices are high, the same security gets you a higher loan amount, right? And it also generates a higher interest income for the lender, right? But if gold prices are down or subdued, the LTV at 75 capped as per RBI regulations gives you a lower loan amount, which kind of caps your interest income and fee income to that extent. So now growth comes back. Most of the banks probably will not be chasing gold loan business. They will go to the bread and butter businesses, which are personal loans, commercial vehicle loans, and other working capital loans, probably to SMEs and corporates, right? So then we will see these gold loan companies take away some more business which is available, and then probably things could be better off from there.
So, sir, what we will do is we will open the floor for questions from community members, and then we will take some more questions. We'll go through the Twitter timeline and we'll take some more questions.
So many fintechs come P2P lending also, they are coming into personal loans. So everywhere you see this kind of competition coming, especially in gold loan also. So in a long run, where do you see, sir? Like, don't you see like too much competition in the same industry will means you don't see that kind of great growth? And in terms of all those banks or NBFCs which are listed, they have huge competition with unlisted peers also.
Very good question, I would say, because so look at the various industries over the last couple of decades. You will see that whenever a sector gets crowded, there is always a shake happens, right? 2000, it was all .com. Every company was into .com business, right? So we saw that there was a shake. Most of the companies did not survive, and who survived, they really kind of did so well. The Amazons of the world, the Googles, probably some of these other names, Facebook, etc., that really survived that bust. Then in India, if you come back, we had a cycle of NBFCs in 1990s, right? 95, 96. There were so many NBFCs that had mushroomed in India. They were corporate lending, they were doing car loans, they were doing commercial vehicles, construction equipment. And then suddenly when the economy went into a recession in 97, 98, most of them had to close shop. So I can give you names like Mafatlal Finance, ITC Classic Finance, Alpic Finance, Gujarat Lease Finance. There were some 80, 90 names I can probably rattle out, and everyone was into this business. And then what was left of Apple Finance, 20th Century Finance. So there were so many NBFCs that had mushroom 90s. Today, these do not exist. And then you had a phase where you had only the good NBFCs that were able to survive, right? So we saw the 2018 crisis, ILFS crisis. A lot of NBFCs were not able to do business because there were no borrowing probably being allowed to these NBFCs, because no one was sure that how good their books are. So then there was ILFS, there was an DHFL, which kind of had that shakeout among NBFCs. Even like I remember in 2018, people were talking negative about Piramal Enterprises, saying probably it will not survive because it has most of the lending to developers in Mumbai, right? But has survived that phase and has come out stronger in that sense. So we will always have these shakeouts that come out. Look at the infra. 2007-8 was everything about infra. Then you had power. A lot of power plants being set up in the country, you name it, they shake out in that sector. Then you have so many other examples. If you were to look at it, these shakeouts are always happening. So now you have fit everyone into that business now. So maybe when you have this liquidity crisis, liquidity starts to tighten now. A lot of these fintechs probably will not have limits to borrow or probably sources to borrow money. Then obviously they'll have to see that what they can do, probably change their business, get into something else, or start sourcing for banks. Right? I have a platform, a digital platform. I have people who've downloaded my app. Can I start sourcing loans for other banks or credit card for other banks? You have Paytm today. Paytm has got a payments bank license, cannot lend in that license. Right, so they are what they are doing. They are sourcing loans, credit cards for NBFCs and banks. So this probably could be the scenario going forward in next 6 months. You never know.
Yeah, thank you, sir.
Okay, so there are a few more questions, on Twitter. So one interesting question, which I believe even I had in mind, and in fact, I think in Kotak on call also this was asked. So we know that the credit cycle looks like it has bottomed out and it's reversing, but at the same time, the interest rates are also rising. And I think in last 3-4 months, some of our home loans, it has got through, 2 rounds of, rate hike. So in this kind of scenario, how the interest rate plays out and how does it impact the industry growth, credit growth, and how it impacts the company prices and all?
If I were to answer it in, probably I'll answer it in 2 or 3 parts. One is obviously when the rates rise or the yields start to rise, there is an impact on the bond portfolio of banks which are held for a sale or for trading, right? The portfolio that the bonds that banks are for sale or for trading, you have to take a mark-to-market loss, which is a notional loss. So Q1 is going to show that impact on the bank's P&L, right? The second part is that if I have a loan book and 60-70% of it is linked to my MCLR or to my repo rate, immediately it gets repriced on the higher side when there is a rate hike by RBI, right? So that book, which was me, let's say 9%, 10%, will start to yield me probably 10.25 or 10.4, depending upon the hike that the has taken on the repo rate, right? So it gives me an immediate bump on my interest income, right? Thirdly, coming on new business, right? So new business, obviously, there are going to be people. Let's say personal loan rates do not matter to that extent that 25, 50 bips going up will not matter to a customer to that extent, right? Who has to take a personal loan, who's got a need, or probably he needs to plan a vacation for his family, he will take that loan. Similarly, for auto loans, someone has to buy a car, and 85% of the cars sell on finance in India, right? So 25, 50 bipsly, the guy will bear out and pay that, because most of the time you will see interest rates are comparable across banks. There could be some bank give 25 bips lower rate of interest than the second bank. Thirdly, commercial vehicles, right? Commercial vehicle is a very large segment of lending for banks, right? So when the economy starts to do well, interest rates go up, your fuel prices are higher, your freight rates are going up. So people, the transport owners do not mind paying 0.5% higher, because they know that if they are able to ply their trucks at higher freight, they can compensate for the amount of installment they're going to pay, which is going to be higher than what probably it was 6 months ago. So to that extent, and home loans, like we all know that the demand for home loans in India is very strong, right? And thirdly, you have corporates. Corporates again depends on working capital. The large corporates like Reliance, the blue chips of the world, will obviously have a lot of options to either borrow locally or go abroad and borrow through ECBs or through foreign banks, etc. It is only the medium-sized corporates that probably feel of impact of higher interest cost. But then again, if your products are doing well, there is demand, there is capacity utilization, approaching your capacity utilization to the brim, you need to expand your capacities, right? So people will set up new capacity, borrow to set up new plants or add new assembly lines or manufacturing units. Overall, it's good because rising interest rate, rising inflation also kind of increases asset prices, right? Your real estate prices go up, your other commodity prices will move up, which is also in a way kind of beneficial to companies in that sense, because let's say my factory land price has gone up, so we mortgage it and take a higher loan amount against it, or my house price has gone up, I need a business loan for my SME unit, I can loan amount to that extent, right? So there are everywhere, every time you have a scenario, there will always be pluses and minuses. But then every owner will look at it very differently, how it benefits or how it impacts him, and he will then decide for himself. Similarly, every individual borrower looks at it and decide. But let's say if I have to borrow for a home loan today, and I see that prices are going up 10-12% every year, it's better to kind of pay 0.5% more on my home loan rather than kind of pay 10-12% higher on that apartment that I was planning to buy, and defer it by waiting for probably the loan rates to probably fall, which may not happen very quickly. And by that time, probably that apartment would be up by 15-20%. You never.
And so there are two more questions. So one question is on ECL provisioning. What is your view? Is it like very harsh measure by the regulator on banks? And the other question is regarding companies. So there are 2-3 companies people have asked if you have any views or how to track or evaluate these companies. One is SBI Cards, one is CSB Bank, and one is, I think, Aditya Birla Finance.
Okay, so the provisioning that RBI has brought in is really, actually, I would say, a little tough on the banks, but also it takes away discretion that banks had earlier, right? Everything is now your model driven. What your model says, based on what the flow rates are in previous quarters, you have to take a provision based on that, right? So it kind of takes away the discretion that bank CROs had, or probably risk heads had on provisioning. So it brings everyone on the same level playing field, So that is all about it. So banks have adjusted to it, and I think so far it's been running fine. Short-term impact on profitability, yes, there would be certain short-term, but probably the portfolios have shown enough performance or behavior. This will also kind of become BAU for banks going forward in the next 1 to 2 years. Then tracking some of these names that we were talking about, CICI is a very small bank, 16,000 crore of loan book, but the management is very strong. Fairfax holds almost more than 50% shareholding. To that extent, so they are trying to kind of grow the bank. So looking at opportunities, if they can acquire some other bank and probably merge and increase size. There were also been some news that they have been actively kind of looking at and talking to probably government or RBI if they can acquire some of the PSU banks that are on sale. So we don't know how the future is going to play out. But so far looks good to me that the management depth, the management and consistency we have seen in the last 3 years in terms of the strategy and the focus that the bank has brought looks so far. Probably next 2 years we will get to know how the bank grows, because if you look at like if my loan book is 15,000 crores, and even if I 20-25%, I would be adding probably another 3,000 to 3,500 crores of loan every year to my loan book. If you compare, like let's say an IDFC first, which is like 1,25,000 crores of loan book, it's still a very small bank to that. Then coming back to Aditya Birla Finance, the company seems to be doing well, but market perception probably is very, I don't know why. It has a strong promoters been buying from the market at such a good price, 100. Then you had Advent International, which came in 1.5 to 2 years ago at 100 rupees per share, along promoter, and also promoter had kind of infused capital at per share. But the share price probably doesn't move. Company has been kind of generating a lot of profits that we've seen last 2 years, quarter after quarter. The only negatives that I see is probably there is a perception challenge of being a group company of Vodafone Idea. Idea is struggling currently, so people think that probably that impact of Idea will play out on Aditya Birla Finance as well. The second thing that which I personally feel is that they are in too many segments, right? It's more like a holding company than a lending company. You have health insurance, you have life insurance, you have home loans, and then you have your other lending, right? So look at the ones which have done really well. The NBFCs have done really well over the years. Bajaj Finance, you name it, most of their business is probably unsecured loans. They finance consumer durables, mobile phones. They will go out and give that loan very quickly. Then they're building up a home loan portfolio, but then Bajaj has a very good thing because it has created huge amount of wealth for shareholders, right, or investors. So obviously, it is looked upon as a more company. You have similarly, you have L&T Finance, right? I would put L&T Finance and Aditya Birla Finance in the same category. More holding companies, rather than do one thing, do well in that area, right? If like Muthoot is only considered a gold loan financer, right? Chola is into the auto business, which is your commercial vehicles or probably the used cars, etc., and all that. So they have to kind of become leaders in one of the spaces and then show that yes, we are here to deliver. But currently there are so many pies that probably the investors do not kind of give them that positive perception about the business. Though they're very strong, it's been growing profits. available cheap as compared to the book value that is there. Hopefully the re-rating probably will take 6 to 1 year, and then probably it could be it could perform from there on.
I think, sir, we are done, and thanks a lot for your time. And it was, a very, fruitfully spent. I think a lot of company names, the 90s era, I didn't even know many of those company names. So it's always good to hear from people, who have gone through those times and, carry that experience. And we all got benefited. And I hope again, sometime again, we will have you on our platform.
Thank you, Saurav, and really enjoyed the talk, and again for giving me this opportunity on your platform. And all the best to you. You're doing a wonderful job, and carry on doing this. I really like your videos, the content you post on Twitter. So keep doing it.
Thank you. Thank you, sir.